Good evening and welcome to CIBPA Speaks. We have a very, very interesting lineup this evening, and it'll be monitored by nonetheless one of our CIBPA board members, someone I call a friend, Sandro Giannini. Sandro Giannini has 31 years at RBC, manages business markets, active in the community, partner closely with the Vaughan Business Enterprise, volunteer at hospice. Sandro is an individual that has quite the character, a man of character, and who's truly a great participant at the CIBPA. And he is a longstanding board member who we cherish his value and his input. And you'll see by this evening the lineup that he's put together. Sandro also, Mississauga Italian Canadian Benevolent Association, Board of Director for Long-Term Care Facility. Without further ado, I'd like to introduce Sandro Giannini from the Royal Bank and his lineup for this evening. Thank you.
Thank you very much, John. And let me start by saying a huge thank you to everyone that's joining us tonight. We know how precious time is, and we value your investment with us and in us. Really excited tonight that CIBPA can continue our speaker series where we provide advice, updates on current business environment events, government events that are going on. We cover the future and culture and so much more. So extremely proud that we can do this tonight. And I'm kind of wearing two hats here. I'm also proud that Royal Bank is a sponsor of this evening. We have been sponsoring and we have been working with CIBPA Toronto chapter for over 40 years. We've been associated with the CIBPA, which is a Canadian Italian Business and Professional Association, 13 chapters across Canada. Really proud that Royal Bank and CIBPA have had this association. As John said, I've been involved for about 20 years myself on that. Tonight, it gives us great pleasure to share some advice and information with our audience. We have two presentations and two topics that we'd like to share. First, we will have Richard Pereira, Manager of Financial Planning and Investment Retirement Planner, who's going to cover off our business owner planning, the process, things to know, give us a brief overview of why, what's involved, and the importance of planning on that. And then following Richard's presentation, we have Matthew Diodati, Manager of Investment Retirement Planning, Financial Planning, who will give us an economic market update. The markets of late have been like a roller coaster and like a casino, I think, on that. So we're excited that we'll present those two to you. As well, we have joining us tonight for our question and answer session that we will have questions and answer after. There'll be a chat function available to you. We have two of our retirement investment planners from the bond market of Royal Bank. We have Luigi Figueroa and we have Gaetano Tassielli that will be available to answer questions tonight. I also encourage you to reach out to them after tonight's presentation directly. If you have anything you'd like to discuss further or in depth, they're more than willing to meet with you virtually, as I guess, on that. And both of the presentations you're going to see this evening will be posted on the CIBPA website, social media on that. So I encourage you to go there. And we are recording tonight's event as well. So as we just turn it over to Richard, thank you again, Richard, for walking us through business owner planning. I always hear plan your work and work your plan. I know you're going to give us more insight than that. So thank you. Over to you, Richard.
Well, thank you very much, Sandro, and good evening, everyone. Again, really appreciate everyone's time and allowing us the opportunity to address everyone this evening. Two very important topics. We had to flip a coin who was going to present first, and the overriding theme was the order of which would keep everyone in their seats as long as possible. So Matthew typically does a really good job with an economic update, so we're going to have him present last in hopes that we get a good balance of topics shared with everybody today. So I'm going to go ahead and share my presentation with everyone. So the topic of business owner planning isn't new and isn't something that's unique to RBC. I have had the pleasure personally of working for RBC now. Will be 20 years in April. And I've had the privilege of also working directly with business owners for about six years directly, in the capacity of a senior debt lender for small, medium, mid-market corporate enterprises. So I've had the opportunity to work inside retail stores, inside law offices, accounting firms, architectural firms, all the way to manufacturing plants. And I've also had the privilege of being in a household where my father had and operated a business for 30 years. So the topic of business owner planning is very near and dear to my heart. And again, as I had mentioned, it is not a new topic. However, what we've realized over the last little while is that there's been an abundance of transitions of businesses from one owner to the next. And, RBC is really wanting to take a more proactive approach to how we provide value and advice to our clients. And with so many of our business owners that we see are going to be changing hands over the next 5 years, we feel that this is an incredible topic that we want to bring to as many people as we can. Today's presentation is really just an overview of what we can expect in terms of the dialogue, certainly not exhaustive, but essentially after today, if there's any interest piqued that we want to take conversations further, we're hoping that between Matthew, myself, Luigi, and Gaetano, we can certainly help and address everyone's questions. So the good news about business owner planning is that you can never start too early. So whether you're starting out, growing, or selling, the idea is that you want to be in a position to grow your business to a point where if anything were to happen to you personally or to any of the shareholders, or if there was a major disruption, you would have the infrastructure to be in place to ensure that you have the confidence in knowing that the business as a going concern continues as it should be. From my experience working with so many business owners, the primary objective, apart from getting the business started, is to continue to grow that business to a point where it's not today. You want to be able to hire more individuals. You want to grow it to a place where it's more profitable. But oftentimes we lose sight of the things that we don't know that could really have a material impact and sometimes negative consequence to the business as a going concern. So some of the key questions we really want to answer when we're talking about planning for your succession, or when you're planning for your business exit strategy, we kind of boil it down into 5 key questions. Is your business structure effective? What is your business worth today? What if the unexpected happens? Succession planning, and ultimately what your retirement looks like. So a good starting point in solidifying your business succession plan is to review the current ownership structure. There are a number of factors that a business owner, with the help of their professional advisors, must consider when determining the most appropriate ownership structure for your business. Some of those factors that include simplicity, control, tax efficiency, and creditor protection. And I would say that the ownership structure of your business today can play a tremendous role in ensuring that the transition of your business to any one of your potential successors can be achieved in a flexible and a tax efficient manner. Every family and every business is different. There's no, cookie cutter approach to how you want to go about identifying what the best corporate structure is for you. The position RBC takes with so many of our business owners is that we will provide as much advice and counsel as you need. Essentially, we do not implement anything. And so what we talk to our clients about is with the expectation that they take some of the recommended strategies and take it forward to either their lawyer or accountant to validate, because we actually don't know what's actually happening or what's been planned behind the scenes. And we don't want to intervene, but also we want to add as much value as we can. So essentially, when we're talking about the different structures, there's 3 main ones that we really come across. The majority of which is whereby you have shareholders of a company who own the shares of their company directly or personally. So you might have a sole shareholder, or you might have 2 or 3 shareholders where they own the shares of the company directly, which for a number of people can be the right approach. However, what we've experienced in a number of our conversations with clients is, this is an often overlooked approach to understanding is whether or not you have the most effective structure possible. The next step of having that corporation is looking at a potential holding company. And essentially all that means is the holding company will own the shares of the operating entity for the main benefit of creditor protection, or to retain the profits from the operating entity in the holding company. You would also think about non-operating assets that you would want to have within your holding company to not form part of the balance sheet. And part of the reason why that would be the case is, upon disposition of assets. So if you're looking to sell your business at some point in the future, the CRA does require what's called a purification process that takes anywhere between 2 to 3 years in order to qualify for the lifetime capital gains exemption. And one of the biggest reasons, one of the biggest areas that they're looking at to validate that is making sure that the operating entity has as many non-operating assets in the operating company moved into their holdco. And I think that's mainly for everyone's, for many shareholders' benefit, and because, again, in the event of a liability or in the event of a lawsuit, you want to make sure that those assets are far removed from the operating entity. The other one, which is getting a little bit more into complexity, talks about a family trust. And this is really coming into the effect where your business is growing very rapidly and you have multiple employees and or family members involved in the business. So the idea of a family trust adds flexibility, control. It provides another layer of creditor protection, while also maximizing future tax savings through income splitting with adult beneficiaries, while also enabling you the opportunity to multiply your capital gains exemption, which today is around $824,176 indexed to inflation, so that you, as your value grows, you can take as much income out of the business tax-free as you can. The last little bit to that part, which is, again, getting into a little bit more complexity, talks about an estate freeze, which is it is a common business strategy, again, for businesses that are experiencing rapid expansion and growth, that transfers all or part of the future growth of your business to younger family members. Again, to complement the family trust, you want to achieve a tax deferral and tax saving strategy. And the estate freeze itself typically involves one of the above structures to make sure that it's achieved in transition in the most effective and transition possible. So what is your business worth today? And so this is a very, in some cases, can be a very controversial topic of discussion. There's multiple ways to have this discussion. Essentially, like real estate, what your business is worth today is basically what someone's prepared to pay for it. So the conversations that we have with our clients is less about trying to provide a valuation to a company, but what ways we can provide help and value to help grow that value of your business. And we can talk less about what you should be doing and more about some of the pitfalls that we see with our clients. But to sell a business today, there's really two options. One, you want to either sell the shares of your business. Selling the shares of your business gives you the opportunity to apply for the lifetime capital gains exemption. Or in the case of my father, who was a business owner, it made most sense for him to sell the assets of his business. And when you weigh out the pros and cons of which, you have to do what's best for you and your shareholders and your family to evaluate. There's a couple different ways to value a business. The most common that people talk about and negotiate in a business negotiation is a factor of a company's EBITDA. So basically the earnings before taxes, depreciation, and amortization. It's a multiple based on the business, the recurrence of cash flows, the industry that you represent, and the ownership structure that you have. And the other approach, which is typically more reserved for larger corporations, is the discounted cash flow approach, which again, that's typically companies that trade on the S&P, and not something that we get into a whole lot of discussion for. Now, to maximize a multiple of your company, one of the biggest pitfalls that we do see, when trying to evaluate the company's worth is, when a vendor or when a company is looking to buy another company, one of the things that they want to have some assurances of is future recurrence of the cash flow that they represent today. And so when they take a look at historical cash flows, most of that is either going to be a function of the accounts receivable that you have on hand, And with the accounts receivables that you have on hand, if 80% of your receivables make up a large proportion of your total gross revenues, that typically represent a concern for a future buyer, because in the event that one of those customers decides to walk during a transition, materially impacts the valuation of your business. So one of the approaches that we see, and again, one of the pitfalls we continuously see is a very muted client base to a total annual revenues for client businesses. So diversifying your customer and supplier base is one of the biggest things you can do for your businesses today to help increase your value. The other part that we see is a big pitfall, which is the current management infrastructure of our client base. And so what we really mean by that is, does one person control the entire business? Is it two people that control the entire business? Well, let's play a what if scenario. What if those two individuals weren't in that business today? Would that business be as successful today than if it would be if those two or one individual wouldn't be part of that business? So a lot of the conversations that we have with clients is, taking a look at the current management structure today and feel, is the business largely dependent on one or two players? And if so, we need to start expanding the infrastructure of that company to make sure that it's not solely dependent on a couple individuals. And for some businesses, it doesn't make sense to do any of that, because there's a point in time where you're not going to feel like you need to grow it as big as you'd like it to. And others, that's probably a more of a longer term approach, but at least having that discussion today can start planting the seeds in determining how to have the most optimal value for your business. But essentially, if you are interested in looking at evaluation, the best way to go about doing it is going through your chartered accountant, or you can hire an independent chartered business valuator whose sole position is to provide essentially an appraisal of your company based on the factors that we talked about earlier on. So what if? I think the what if approach is largely the premise of this entire conversation. Business owner planning isn't a strategy to make your company more profitable. It's not a strategy to help grow into other markets and key segments. It's making sure that what you've started from the onset is preserved and enhanced for the continuity of future shareholders, for the continuity of the business as a going concern, for key employees and partners. So part of the unexpected, or planning for the unexpected, is making sure you develop an estate and a contingency plan. And it is so critical that you address what a death, disability, or illness of yourself or key employee would mean to your family and essentially to your business. One of the key ingredients that's often overlooked, and in the case of my father, who is a business owner, is having a look at your legal documents. And what we mean by that is most business owners today do have a copy of their will and power of attorney. But what we don't see, and what we're having more conversations with our clients, is the introduction of a corporate will or a secondary will, which is very important for a number of reasons. A corporation is an entity all into itself. Your personal assets of what you've acquired are completely separate. Commingling the two in one can have an abundance of conflicts down the road. And being able to separate the two is just a more efficient way to deal with the estate. And that's number one. Number two, upon death, the CRA does what's called a deemed disposition of all of your assets. And so it basically sells all your assets at the time of death. And so as an estate, or as an executor rather, one of the things that you want to avoid at all costs is the idea of having your estate go into probate. So the idea of having a secondary will essentially enables those corporate assets on its own no longer is subject to probate. And so for the cost of spending perhaps another $1,000 or $1,500 to create a secondary will and to remove corporate assets from one to the other can save your estate and your executor hours and hours and hours and thousands and thousands and thousands of dollars of unnecessary costs to court taxes. The other is to make sure that if there are multiple shareholders in a business, you want to have an effective shareholder agreement in place. And there's a number of reasons why. God forbid anything were to happen, you need to have an agreement in place to determine who's going to take on for those who are shareholders today. Too often times that when you have a will in place and you're a business owner and you pass away, it typically goes to the surviving spouse. So Not sure if business owners want to be in business with their partner spouse. But if you don't have a proper shareholder agreement in place, that could end up being the default position. A complement to those legal documents is making sure you have sufficient insurance and coverage in place. And so I think this is probably the most unbiased part of the advice we give to our clients, particularly because as much as we are capable of providing correct insurance advice, we are actually not allowed to sell any of our insurance to our clients, as it's a mandate by the Bank Act. We can't even refer our clients to people we know in the insurance industry because it is a compliance no-no. So it's essentially the most transparent way we can give unbiased advice, knowing that we actually can't sell it. But what we do find is most of our clients are dramatically underinsured. And so life insurance is one of the most cost-effective solutions to create a pool of capital that your survivors can use to meet their lifestyle needs. They can pay for your taxes at death. The taxes payable at your death should be estimated, particularly the capital gains tax at death related to your business shares, which can be significant. And at the same time, they can determine if your state has adequate liquid funds to pay for the taxes. And if not, then insurance can be a more cost-effective solution to pay for the taxes instead of depleting existing assets or taking out a loan. So succession planning is an interesting topic in terms of timing of transition. What I do find it's interesting when I talk to most business owners, my father being one of them, is business owners don't typically identify with the word retirement, nor do they ever feel like they're ever going to exit the business. But at some point in time, whether you decide you're going to retire or not, you are at one point not going to be a shareholder. So you want to start thinking about that at some point in the future when you're looking to dispose of your assets. So you can look at selling to a third party, to a family member, or to someone within the company. And I'll tell you a couple quick tips on that. Selling to a third party is going to typically yield you the highest return on what you want to sell your business before. But the risk of doing so is when you're casting a wide net to an audience of potential buyers, you compromise the privacy of your business. And when you have vendors or when you have folks who are in accounts receivable that know that your business is up for sale, it potentially puts a little bit of liability and risk against future collections, also on vendors not wanting to pay. Family members and key management typically are the smoothest sales, but because it's family and because it's key members, you want to sort of see the business go as a going concern. And so, you don't compromise the privacy, but typically we do see the valuations and the share prices come down a little bit because when you're selling to family, you want to give them a bit of a break. And when you're selling to key employees, you typically give them a break. And the last little bit here before I stop is, the retirement planning piece is equally as critical as the succession planning. And it's something that we're spending an awful lot of time and endless amount of time with our clients having these conversations. There's a lot more that comes from selling your business that we can help with. And what I'll say is after today, Gaetano and Luigi are two of the most excellent resources that we have on our team that can take these conversations to the next level. And hopefully there's a few points that you've all taken that you can walk away with, or if there's any questions, we'd be happy to answer after today's call. Thank you so much for your time. I'll pause there, Sandro, and I'll let you turn it over to Matthew.
Well, thank you for that, Richard. I always pick up more information every time I hear that your commercial banking background really came through tonight. I could really sense that you were able to blend the background with the wealth management. As you were speaking, I was making some notes to myself. To our audience, if you're considering on being a member of the CIBPA, part of our main function is to network you and introduce you to other business owners who will help you either start a business, grow your business, merge with a business. We can introduce you to maybe new suppliers. We can help you do trade overseas. The power of the CIBPA network, as a member, you have a full access to our membership and our reach. And part of our main function is to help your business grow. And you do not have to be Italian to be a member. So please keep that in mind as well. So we either help you start it, we help you manage growth, or what we just heard is, hey, what am I going to do with this? I don't want to work forever, or maybe I do, but we help you, we put you in front of the right advisors that will help have a conversation with you with some of the things that you've just heard. So thank you very much for that, Richard. The second part of this evening was something that we've heard so much about in the last little while. And Matthew, you're going to help me out here because I'm as confused as, I'm hearing things like the market and some GameStop and Bitcoin and what happens to my shares and what do I do? And stop the insanity, Matthew, please. Thank you for sharing with us this brief economic update. And again, to the audience, if you want to get more information, because we can only do so much in the limited time we have this evening, please reach out directly to Luigi or Gaetano, and you can approach us, or even through the CIBPA office, we can get you in touch with the right people. So Matthew, thank you for joining us tonight.
Yeah, thank you very much. And there's a lot to cover. So I appreciate everyone's time, and to Sandro's point, I'm going to get right into it, do my best to help everyone out and make sure there's time for Q&A. So if there is any pressing questions, anything keeping you up at night, let me know. Sandro, just make sure the Soprasata you promised me for presenting tonight is on my desk tomorrow morning, and all will be well.
You got it.
So I usually like to start these off with a report card, just to give you an idea of how asset managers are thinking, what they're focused on. I think a lot of times where there's a disconnect when you're investing and when you're looking at what's happening in the news and what's happening, with your actual investments, if you are invested, is, sometimes always move lock and step. And even, economists can get things wrong, asset managers can get things wrong. But I think this is a good place to start. Now, there are negative developments, positive, and things I'll call, let's call them neutral. They're kind of middling. If you look on the left-hand side, the negative comments, these are generally things related to the virus COVID-19. You can see that there's a sustained high infection rate around the world. Some areas are better than others. There's a new virus variant that may be a bit more easily transmitted. South African one is apparently quite nerve-wracking to some. In North America, towards the end of the year, some economic indicators had started to soften, and also inflation expectations edging higher, which has to do a lot with monetary and fiscal policy. So a lot of what governments and Federal Reserves and banks, et cetera, are doing, to help ease some of this pain and make sure that the economy can keep moving forward. If you go to the middle column here, positive developments, they are, again, in line with COVID-19. You can see that Europe's infection rate remains substantially low. Things in the US and Canada are kind of stabilizing. Indicators in Europe are a little bit better. I'll talk about that later. Vaccines are being delivered. They're not everywhere. Brexit, how about that? I haven't heard Brexit. It seems like ancient history, Brexit, but apparently a deal has been struck. Actually, RBC Global Asset Management has conversely, positive outlook relatively compared to consensus. We tend to be a bit more conservative. And then things that are interesting, this is kind of in the middle, depending on what side of the coin you're on, these could be good or bad. Expected further US dollar weakness. So if you have businesses in both the US and Canada, that's an area that you may want to listen into. And then also Biden's government has been in office since January. I think before we kind of get into what's happening right now, it's really good to understand how we got here. It's been almost about a year since the pandemic really picked up. In February is when we started to see things happen more so in the news. And I believe, if I'm not mistaken, I remember I was on my way to a meeting and I got a call from my boss, beginning of March saying, hey, go home, no more face-to-face, anything like that. So, and that was, I think it was like first week of March. So just, not that far away. So we know that we kicked 2020 off with a bang. We endured elevated levels of volatility. And if you speak to Gaetano, and if you speak to Luigi, myself, Richard, anyone really in the finance industry, there were a lot of people nervous about what was going on. But we've come out of that. We've experienced exceptional growth. And I think there's a few things to think about when we look at, why we've come back. I think some of these things have kind of settled themselves. Some things are still kind of percolating. When we first dipped, if you're looking at the beginning of this dark blue line on this chart here, economy shrank between 10 and 25%. The US lost about 15, Canada shedded about 18%. And although the magnitude of the collapse was really quick, really short, it was the fastest decline we've seen, since the Great Depression, hence the comparison and the title here. We actually bounced back pretty strong. And, if you think about how many people were actually, not working, kind of furloughed at home, how many businesses were shut down, you would expect an economic decline of, 50% plus, but that wasn't the case. And, the second thing to think about is the duration. So like how long this occurred, what was the length of this impact on, the marketplace? And it was actually quite short, lasting no more than a month. By the end of April, things were already back on the way up. And then the rebound proved to be, quite enthusiastic. So with half of the initial economic decline recovered with just 2 months. So by the end of June. Now, the other thing to think about is economies reclaiming their pre-pandemic levels and, what that looks like. We're actually quite positive on that. We're not really too worried about when, the exact date of vaccines coming are, more so, the fact that they're coming and that they're going to be available and that we'll eventually get the herd immunity. And I think that's a positive thing. We actually believe that Canadian and US economies by the final quarter of 2021 will be looking pretty good and back on their way to where they were. So past that line across the middle, that 100. And then we think other major developed economies will follow in 2022. So Europe, Japan, United Kingdom. And there's other things to support this as well. So policymakers have been quite accommodative along with central banks, which I'll touch on. And then also pent up demand. So just the fact that people are saving, quite a bit of money. One thing that we know is that if we look at traditional data, it confirms a significant rebound. Though this is highly varied, you may hear words like bifurcation, K-shaped recovery, where some, companies are doing better than others. And, we've seen retail sales completely recovered. Most sectors have recovered more than half of their decline. Food services continue to be, they continue to struggle, if we're being honest. And they've been able to adapt, with curbside pickup and change their business models a bit, but not operate at full capacity. And then there's others that are significantly impacted, like hospitality. Think about, not to pick on any companies, but like Carnival Cruise Lines, things of that nature that really can't operate where they'd like to be. Overall, though, the Canadian economy has recovered at least 70%. And, despite considerable economic damage, we've actually been pleasantly surprised by the economic impact and recovery so far. So, realistically, we're not wearing rose-colored glasses. There's no guarantee that this happy trend persists, but it seems reasonably likely that, as demonstrated by, China, which is kind of the bellwether first really to be infected and things start moving on. They've had a complete revival, with historic financial gains thus far. So, we can assume that with their amount of inoculation and what potentially could come down the road, for other countries, that's something, to look forward to. This was an interesting chart. I actually just got this today and kind of slipped it in here. And I think this is really important to think about, when you're reading news, when you're speaking to your financial planner or advisor or whoever you're talking to with regards to investments. But this chart tracks daily sentiment in the news. It's called the Daily News Sentiment Index, and it measures economic sentiment based on analysis of economic related articles. So everything that's going out based on the economy. And what you can see here is that it was doing quite well, and it's kind of slipped. So going through the summer, and it's kind of slipped back. Now, economic news can be good, can be bad. However, the greater influence on markets is whether the news is better or worse than investors expected. So if you're an investor and you're investing for the future, you're really, kind of like golf, where you can handicap a golfer who's really good. You're kind of, estimating where things are going to be. You're looking over the valley, thinking, where can this company be down the road if I'm investing my money now, and can they survive, what we're going through. It's more of a question of, what investors have priced in and assumptions, which is why you sometimes don't see markets move lock and step. And, with this backdrop in mind, investors may question whether now is the right time to put money to work, whether, several markets hovering around all-time highs. Investors are facing, essentially the highest price they can pay ever when a market's at the peak. In the last couple of days, we've seen things pull back. A lot of the people who are invested in tech stocks, if they're on the phone, may have, felt that over the last 2 days. But this creates psychological, barriers to entry, kind of preventing clients, at least that we see on a daily basis, from investing, even when, when they know they should, which is, part of the, part and parcel of the financial plan. Having a plan will kind of help you stick to where you need to be. But I thought this was really interesting because that really drives a lot of, the investor behavior that we see, in our branches and in front of our advisors, et cetera. So looking at the U.S. economy, this is an index, an activity index that RBC GAM looks at. And if we look at how this has kind of trended, we can see this sharp drop, last year in the springtime with a very quick partial rebound, as we discussed, and then kind of just stagnation, nothing really happening, things kind of staying still, and then during the second wave, which, it actually could have been worse. And now we're trending downward again. And, the US now going through its third COVID-19 wave appears to have peaked despite the less aggressive economic restrictions, than elsewhere. This could prove sustainable as lockdowns broaden, but it may just reflect under testing, over the holidays, similar to what we saw with the numbers after Thanksgiving, where there's a little bit of artificial suppression. Now, if we're looking at Canada, Canadian businesses, they've been forced to shutter. I live in Halton. I know across GTA, et cetera, and in Ontario, where I reside, and I'm assuming many others, you've been forced to kind of, if you do have a business, only certain can operate. I think they just opened, hair salons, per a colleague, told me last week or the beginning of this week. And, Canada has, they had a good summer. It's now we're into a severe second wave. The increase is a function really of like colder and drier weather, easier economic restrictions over the summer, and social distancing, fatigue, restart of schools, et cetera, as well, which was a good thing for me because I have 3 kids. So it's good to have them out of the house if it's safe. Now, it appears that COVID numbers may have peaked in Canada. Things aren't perfect, but this could also reflect testing during the holiday season. So we got to see what the next few weeks look like. Job numbers in Canada, specifically in January, we had 2 declines, 2 months of decline in a row. So we're seeing some real, weakness there, some very misleading indicators from Canada. Not all bad, not all good. Our base case is that, slightly negative for first quarter GDP in Canada, but potentially some positive towards the end of the year. Now, what I think is important to consider is the resiliency of, the human spirit, especially any Italians on the phone. If you're Calabrese, you're probably not going anywhere, right? So the second wave economic damage, it's set to be, I guess, if you look at the order of magnitude, similar to the title here, you want to look at, how bad is it going to be if this happens again? Are we prepared? You can see some of the bullet points on the left-hand side. Business and people are used to kind of operating, wearing a mask, waiting in line. There's a little less fear and paralysis when people are out there. Rules aren't as strict depending on where you are. And although some sectors are almost completely shut down, there are a tiny percent of GDP. And then unlike spring, you have manufacturing, you have construction, real estate, mining, education running normally, which is a benefit for the economy. Now, I think this is what's on a lot of people's minds. You have this new contagious virus in South Africa. It's supposed to be really vicious. The UK variant appears to transmit 56% more easily, have 30% more morbidity rates. So it's a little bit more deadly, and now being detected in other countries. I think they found some in Vancouver. I don't know if they found some anywhere else. The new variant is likely to become a dominant global strain. So this would mean more infections, potentially more fatalities. And this is kind of now we have to wait and see. Did the vaccines that have been developed work, against these new strains? Is the efficacy the same? Do they need to develop something new? And this is where a lot of uncertainty comes, which is where volatility in the market comes from, which is why you get these ups and downs, gyrations in the markets, even though some things may be good, things may be reporting quite well. So there could be further mutations. This is something that we're keeping our eye on. And again, it's really about getting the vaccines out and into the economy. It's not so much the date, but knowing that we can actually battle this and get to some type of herd immunity, which is really what we want to keep our eye on. Now, the good news is this, UK having one of these strains, we can see that dark blue line, that is death rates going up, but you can see infections going down. And this speaks to government controls, people social distancing, and inoculation as well, because I believe they've started that there. But what's more is, what to expect for vaccinations. So setting the expectations for governments, for people in terms of what we can look like. And you can see at the bottom of this chart here, herd immunity is essentially 70% of the population or more. We can hope to achieve this by summer or early fall. This is what we know now for the UK and the US and other major developed countries following. So you can see Canada, Eurozone, and Japan somewhat slower. But on the right-hand side of this chart where you see those green boxes, you can see that the effect on the economy is a moderate boost. But the caveat to that is to the right of that. This depends really heavily on what criteria governments use for reopening. So are we inoculating and then still slowly opening? Are we fully opening? And these are the things that we're keeping our eye on to see, where things are go, how fast we may receive some, see some growth in the economy that we are expecting from what you can see in this chart here at the bottom, pent up demand. Now, another thing to consider as well, and I briefly mentioned it, is that you may have expected a 50% decline in the market, but that really hasn't happened. The effects that a lot of people expect to see in terms of things pulling back, we haven't seen. So the lagged credit problems, there have been, slightly more credit faults, but not historically peaking compared to other things. So no evidence of a serious problem, at least not at this point. Housing market, I think we all know what's going on there. Fiscal drag, we haven't really seen a halt in growth. We have 2 rounds of fiscal stimulus. I'm going to talk about that in a moment, but more so the pent up demand. So when people can start spending, when people can go out. I know I am dying to go on vacation and get out of the country personally. I've just been sitting in this basement that you see here. I live here. I'm allowed out once in a while to get food and water. I got to call my boss and say, hey, can I leave the computer? But I live here. This is where I live. This is everything. That's why I got so many pictures on the wall. This is everything I have just in my head on the wall here. So I'm looking forward to it. I want to be part of that pent up demand and get the economy going. But again, no rose-colored glasses. There are risks. There's a variety of macro risks extending in different directions. And you can see that a lot of the risks are also, could be some of the positives as well. So the biggest downside risk is really the business cycle as opposed to Brexit and, protectionism, which would have been, the trade wars that we were hearing a lot about with, with Trump and his, his house or his house, I don't know the term, but with Trump. And the biggest upside risk related to the policy makers delivering additional monetary and fiscal stimulus, which is what I want to touch on here. And I'll wrap this up quickly. I know I got about 2 minutes to stay on time here. So inflation is really big in the news, and this is affecting a lot of things. As inflation rises, things that you're willing to pay a bit more for, tech stocks are a good example of this. They have high earnings expectations, but if inflation goes up and rates go up, the risk that you're taking for that maybe isn't as good compared to something else that you can get somewhere else in the market, which is why you've seen a bit of decline amongst other things. But the fiscal and monetary stimulus response that we've seen for this pandemic has been substantial. There's been rapid action, whereas if you go back to the financial crisis, 2008, 2009, it took over a year. I think it was like 2 years before we actually got a package. Now it was like weeks, like 2 weeks. It's like, here you go, money, CERB checks going out. All you needed was a heartbeat and you get money in the mail. And you just had to sign your name and you were good to go. Now, these actions are likely to accelerate, some trends, but part of this case has come through, quantitative easing as well. So for those who don't know, quantitative easing is when a central bank prints money or expands its balance sheet by buying bonds and things of that nature. Now, for anyone who's trying to stay up to date with the news, earlier today, actually, U.S. Federal Reserve Chairman, I think it's Jerome Powell, I believe is his first name. If I'm wrong, I know his last name is Powell, but I think it's Jerome Powell or maybe Jerry Powell. Says the economy is really a long way from the Fed's goals and central banks, and it has no plans to raise interest rates. They have a 2% target, and they're still going to continue bond purchases. So he did downplay worries in terms of adding to, I think it's like 27 or 28 trillion dollars of national debt, which eventually could push interest rates higher for consumers and businesses, et cetera. But for now, the borrowing costs are historically low. And RBC GAM expects rates to stay historically low, even though they can go up a little bit. Now, there was a reiteration as well from Powell that to keep its benchmark short-term interest rate near zero, they're going to continue to do that. And they're also going to continue with their $120 billion a month treasury bond and mortgage-backed securities effort. So you can expect to continue to hear about this in news and something to be a theme going forward that lots are looking at. Now, for business owners on the phone that are dabbling in US dollars or trade in US dollars if they're dealing internationally, et cetera, we do expect the US dollar to continue weakening. This has been a part of our long-term thesis for quite some time at RBC Global Asset Management. we believe that it's going to remain in a bear market for several years, with other currencies appreciating, with exception to the Canadian dollar against the US dollar, that is. Now, this is primarily a function of the overvaluation, some technical patterns for traders, and also related to Biden and what he was planning on do with stimulus. Now, one thing we can say is that with some confidence is that the U.S. Federal Reserve approach to monetary policy is working against the U.S. dollar, obviously, and with limited space to maneuver for short-term interest rates. The Fed has been the first major central bank to indicate that it will allow this to continue happen and even encourage it, right? So this is why, again, you can expect a little bit lower inflation. So there's a bit of a connection there between the two. Now, we get asked quite a bit about the presidential election and how that would actually affect what was happening in markets. And this chart's a really simple way and good way of showing that overall, if you look at the bottom line there, things are actually quite positive. You can see the US dollar on the last column there. On the bottom right, it's actually not the best, but here are some of the main policy considerations that we look at. It's not an exhaustive list, but overall, good for the stock market, maybe not so good for corporations. They tend to like more Republican government because they're a little bit more lenient on tax, but for equities, for long-term economy, short-term economy, and even bond yields, we can expect that the Biden presidency is probably overall good. We still have to see that pan out, of course, but we'll see how that looks over time. Now, how does this affect us? For those chiming in from Canada, I was told there could be some international people here, but it's more good than bad. What's good for the U.S. economy is usually good for us. Less vaccination nationalism. So without the trade wars and Trump kind of hoarding things, U.S. factories might supply Canada. So we'll have to wait and see. Less political uncertainty, and you can see the list goes on here. And then things that are bad for Canada, I think the major ones, the XL pipeline kind of being shut down. If you're out in the West, that was not a good thing. Maybe more Buy American, which may be tough theoretically. And then weaker US dollar under Biden, which equals reduced Canadian competitiveness on a global scale, which is what I was referring to on the last slide. And then more US immigration might reduce the quality of immigration to Canada, which is a big part of our success and our GDP as well. Now, I usually like to end just with this particular chart here, because we get asked all the time, and you can ask anyone who works at RBC on the phone, is that, is a recession coming? Is a recession coming? Well, realistically, this black swan event of COVID-19 has kind of pushed us, over the edge and into that. And we're actually showing more signs of an early cycle. And the way to read this chart is you'll see a lot of so right in the middle there, you see a lot of the dark boxes filled in. The darker the box, the more strongly we feel about that. And you can see on the left-hand side, some of the indicators that we look at. And again, this is not an exhaustive list, but these are some of the major ones that we look at quarterly. And this is really just our business cycle scorecard. So most things are looking at early cycle, so we can expect growth moving forward. Obviously, all of the things that I touched on with regards to vaccines eventually coming out, et cetera, are going to be a part of that. There's always uncertainty. We do expect volatility in the short term, but we have upgraded our outlook for every major developed region due to the surprising speed of recovery, promising vaccine development. So not when, but that the fact that we are getting it, the favorable U.S. election result, and monetary and fiscal stimulus and policy that's very accommodative. So Eurozone and UK growth, we're expecting to be the fastest among the developed nations in 2021, not because we expect them to lead, but because they were so far behind. And this outperformance is really related to that. We believe the US and Canada economies will be back to where they were GDP levels pre-pandemic, hopefully by final quarter 2021, based on what now. And then for major developed countries like Europe, Japan, the UK, et cetera, trailing in 2022. So overall positive, short-term volatility. And we think that, again, we're early cycle, and there is growth in the horizon with maybe a few speed bumps along the way, and hopefully more good than bad, but we'll have to wait and see. So Sandro, I'll pass it back over to you, and I'll stop sharing my screen.
Thank you. Thank you for that, Matthew. I know we asked you to do that quite quickly, and there was a lot of information shared, but I'm feeling a lot better now. So thank you. And yes, the Subrasada will be delivered to you. I do have a couple of questions that came in, so if the panelists can take their phones off of mute. I also encourage everyone, if you have questions, keep asking on the chat. Either Luigi or Gaetano or Richard, when should a business owner start planning?
That's a great question. Now, and the reality is you start and stop, Sandro. Planning is only as good as the moment you walk out with the plan, and then things can change instantaneously. Major life events usually alter the course of where we're our destination, and so having a pulse check on planning is always an important part. So some folks look at it on a biannual basis, some folks look at it on a 5-year time horizon. It really depends on your business, your growth trajectory, and your plans, but planning starts now and never ends.
Thank you for that. There's a follow-up question to that. Sorry, there's an echo. Maybe we can go off of put our mutes back on. Who should be involved in those business owner planning discussions?
Great question. So again, that's not exhaustive, but I think it starts with the major shareholders of the company and your respective family members to the extent that you want to include them. Oftentimes, a lot of business owners do include family working in the business. And when you're looking at a transition to family, it's not a foregone conclusion. Oftentimes that's the expected result. When the reality comes, they have no interest in wanting to take over the business. So having that conversation with family is also critically important. Your bank is always going to be an important part of that process, and even more today, as we mentioned in the presentation, that there's a far more proactive approach from a banking perspective to add that type of value of business owner planning. So whether you think of a bank as part of that planning process at the discussion or not, the bank will find itself to insert themselves in that conversation. And of course, your lawyer and accountant is a critical component to making sure you're having that long-term planning piece, but also the execution of that, and to rinse and repeat and to continue to review.
Thank you for that. Either Luigi or Gaetano, question earlier today, Bank of Montreal and Bank of Nova Scotia reported better than expected Q1 earnings. Your thoughts on that? And I know Royal Bank reports tomorrow, I believe. So some bank stocks or some ideas around the performance of our financial institutions.
I'll take that, Gaetano, if it's okay. Well, we like, when we sit down with clients and we do retirement planning, we always like the bank stocks just because of the yield that they provide, between 3% and 5% on some of them. And, we, especially Royal Bank, we're the largest financial institution in Canada. We're one of the largest ones in the world. So, we're a blue chip company, and definitely we always suggest to have like a dividend fund as part of their portfolio, which includes banks and insurance companies and so forth, just because of the consistency of their profitability, their return to shareholders, and frankly, the yield that they provide. It's a constant yield that they've been able to do for the last 30, 40 years. So it's a constant, which forms a foundation for your portfolio. So we always recommend it.
Thank you for that. Gaetano, we keep hearing, maybe you're hearing from clients as well, Bitcoin, cybersecurity. How are you having conversations with clients around this?
So obviously there's a lot going on in the market right now. And I think the Bitcoins and the GameStops of the world, you could experience a lot of volatility. I don't think it is a long-term strategy. And it's funny, Matthew and I were just talking about this prior to the call. When we ask a lot of people that own these type of stocks and shares, what is your end price? Most people don't have an end price when it comes to thinking about these stocks and financial planning. A lot of them are just kind of in it for the ride. So Luigi and I, Richard, Matthew, we caution our clients that do dabble in this market, such as the Bitcoins, the GameStops. You will experience volatility. Not to say we don't recommend going in them, but we would just, caution it. Take caution when actually exercising these trades. and more importantly, have a financial plan. When you do decide to jump into these stocks and these industries, have a set price that you want to get out, and just be prepared for the fluctuations. But it's probably better to have a one-on-one discussion with either Luigi and I, and we can kind of go more in depth with these conversations.
Thank you for that, Gaetano.
Sandro, if I may, just because it's relevant, today I just had that question from a 24-year-old, and she's never invested before, and that's what she's hearing, right? She's hearing about Bitcoin, she's hearing about GameStop, and some of the other, high flying, the stocks that go up 30-40% in a day, sometimes even 100%, right? So what I tell clients, what Gaetano and I tell clients, and I think Richard and Matthew would agree, is if you want to, first of all, you have to have a plan. Our business is the planning business. So we sit down with clients and we ask questions regarding their long-term plans. After that, if we tell them, if you want to dabble 5-10% at most of your money, and explain to them what Gaetano just said about the extreme volatility, then you can do that. But for your long-term plan, if you want consistent returns, and if you want a retirement plan that fits you, then these high-flying stocks are they're not for long-term investments. So,
thank you for that, Luigi. I'm glad you mentioned that. I just read something from the Financial Planning Council of Canada that Canadians that deal with a planner usually in the long run have better returns than those that don't. So I encourage those on the line here to really consider their advisor and working with an advisor. I'm just looking at the clock. Matthew, did you want to jump in? I just got a little bit of a close to do. Matthew, you wanted to add something?
Yeah, sure. I wanted to add on to all those questions and thoughts. I think with regards to bank stocks, outside of the great comments already made with regards to dividends, consistency, them being a large part of what we know, and people also like to own things they can see. Like you can walk down the street and see a TD in a Royal Bank, which is really good, and say I own a part of that company. But they've done quite well. They do well in inflationary environments, and a lot of the banks wrote off a lot more than they had expected, and they didn't have to actually dig as deep into their pockets, which have benefited them, which is why you're seeing a lot of these good earnings moving forward. So they could, and they're considered cyclical stocks. So as things kind of rotate and the economy kind of changes, you'll see a lot of good things there. And then with regards to Bitcoin, GameStop, tech stocks, whatever the case may be, to everyone's point, there's really no right or wrong. I think you really have to consider, not even just your financial plan, but the strategic asset allocation that goes along with that. So the risk you're willing to take to get to where you want to be, and are you willing to take that? So there are people that are coming into different branches who have never owned anything other than GIC that want to go all in on one stock, and they're retiring in like 2 years. And it's human behavior to be a part of that and want to get there and have a potentially better retirement, but not really understanding the risk. So to Luigi's point, having a risk budget, setting targets for specific prices and what you want to do, that's something that as working with a financial planner, they can actually model that for you, show you what it looks like to take extra risk, to take less risk, and then decide, okay, what am I really willing to risk? What can I not afford to lose? What can I protect? And as business owners, many of you know that you can take $1, you can make it 3, right? You can multiply your money by quite a bit. And I think a lot of what you see at financial plans, you can take $1, you can make it $1.05, you can make it $1.10, whatever the case may be, but you can do that consistently over time with not as much volatility, a lot more security, and then also the benefits that you get with registered accounts, and things along with that a financial planner can discuss with you. So those are very important. I think something to think about before investing in everything. That's all I wanted to say.
Thank you for that. Just you say risk. I can assure you, there's no risk to you if you become a member of the CIBPA. In fact, we will go out of our way to make you. We'll introduce you. If you need something, and we work our network together. We prosper as one. Our communities do better. Businesses are employing people. They're sending children to school. There's so much that's going on. If you enjoyed tonight's event, I thank you again for joining us. One of our proudest events that is coming up on March the 8th is our International Women's Day event. It's actually our 6th annual. We're really proud of this. It will be a YouTube event on Monday, March the 8th at time to be determined. I believe it's in the evening. You can check our website. But our guest speaker, it's in our series of CIBPA Women in Leadership virtual event. One of our board members, Laura Salvatore, will be interviewing Michelle DiManuel, who's president and CEO of Trillium Health Partners. And she's a dynamic leader known for her ability to lead large, complex organizations through significant change and cultural transformation. So, and just, everything going on in healthcare and how it affects all of us. We're really looking forward to this. And again, we check our website, our social media, Facebook, for all of the information on this. We're excited to be able to provide this to all of you again. A big thank you goes to the team you didn't see tonight on the screen. They keep the lights on, they keep the CIBPA open. Barbara, Hannah, Felicia, and our president, John Lettieri, thank you for all you do. And thank you for what you do that we don't know about, because it's making a difference. To our panelists, thank you for giving us your advice, your knowledge, and your time this evening. But more importantly, to those that watched and listened tonight, a big thank you. If you want to get involved with the CIBPA, you can go no wrong. You will feel better and you will be part of something that's making a difference. Thank you, everyone, and good night. Have a wonderful evening. And the RSP deadline is March 1st, right, guys? Yeah. Thank you, everyone. Good night from the CIBPA, and Royal Bank is our honored sponsor this evening.